So the profit sharing ratio will be governed here. We have also the objective clause. For you to come into business, there must be and main objective. Why are you coming to form a partnership to pursue the same goal? That's why we say it. This is what objective clause. The main purpose of starting that partnership business. And then you have the name clause, or the name of that business, the name of the business. So if examiner asks you to give at least 3 content of partnership deeds, you will give this. After that, you need to know how to prepare the statement of profit and loss and appropriation account for partnership. The name is just is a stranger's name, the partnership, but the accounts remain the same. The statement is the same. We'll have to start with the sales, cost of sales, which will took the opening stocks, they add the purchases, less the closing stock, you arrive at gross profit. After that, you less the expenditure, which I have not specified here. Remember, the expenditure, there are so variety of expenditure depending. So we will only go with what examiner has provided us. But for now, we can just generalize and say expenditure, which it will take us to arrive at net profit. After arriving at net profit, now we bring in a partnership accounts there, which is called appropriation account. This appropriation account, we will take this net amount. We will take this net amount. This net amount is the one you will bring it here. And then from that net amount, we add the interest on drawing. Interest on drawing. Remember, if a partner takes goods or takes some assets, and then you will charge interest, which this interest will increase the shareholders' capital or the shareholding capital. That's why we are adding back. And then we will less the interest on capital. So if there is any interest which is earning from the capital which the partners have invested in the business, then they will have to take it at any time, maybe on a monthly basis or a yearly basis or a quarterly basis. That one will reduce their what? Their net profit. And then you might find one of the partner is a full director or is the one who take day-on-day activities managing the business operation, and you have to pay salary. So we will less that salary here so that we can now arrive at profit to be shared. This profit to be shared, we will share according to their what? Profit and loss ratio. Profit and loss ratio. And the partnership bit is the one which will govern us. This is the profit clause. So if there is profit ratio change in a time, then we will have to shift to that profit ratio, because the ratio can change due to what? Admission of a new partner or the retirement of a new partner. That's why the profit at one point can change. So it is not constantly throughout the year. So that's what you need to know at the introduction, the format of this. So we'll have to see also the format of a partner's current account, because also examiner, they do ask the format of what? Partner's current account. So partner's current account, we have the balance brought forward, which we credit, and then the interest on capital, we also credit, the salaries we also credit, and then the profit which we will get from appropriation account, we also credit. In this partner's current account, they also have the drawings, which drawings should be debited, the balance brought forward, and then we have drawings. If we also have the interest on drawing, you can also debit. And then if it happens that the partner has taken some assets so that we can't recover it back from their capital, then we also have to credit that asset, or the partner has taken a loan from the business, then we will also debit that amount that amount. So this will bring the end of the partner's current account. Then you also need to have the partner's fixed capital account, the partner's fixed capital account, which we have to look at that one in few minutes. So before you opened the partner's capital account, you will find that at one point the partners, or you will admit a new partner, or you will retire the current partner. And in that case, the partners will have to open the goodwill amount, the goodwill account, to know the value of their what? Of their goodwill. So they can decide to write off the goodwill, or they can't leave the goodwill to continue. So if the partners decide to write off the goodwill, then you have to open the goodwill account. You have to open the goodwill account. As we all know that goodwill is intangible asset. Goodwill is classified as intangible asset. All the asset, what do? We debit. So we will debit the asset with the old sharing revenue, or before the admission or the retirement of a partner. So we will use the old revenue to debit this value of goodwill. And then on the credit side, we will use the new revenue sharing ratio to distribute the value of goodwill. To distribute the value of goodwill. So you can see in the pot side, they will all affect the capital account. So whatever in a debit side here, we will take to the credit side of the capital account. So, but this balancing figure here is the one which we will bring it here as the goodwill, and we will credit this amount. The one which is in the credit side here should be debited in the partner's fixed capital account. Remember, the double entry should be observed. The double entry should be observed. Also, maybe in between the year, the asset has been revalued either downward or upward. So if it is upward, then we have a revaluation gain. That revaluation gain, we need to share. We need to share that revaluation gain. So we will also bring the revaluation here, and at the end of it, we will get the balancing figure here as the balance carried forward. That balance carried forward is the one which you will take to the balance sheet on the side of what? Equity and liabilities. Equity and liabilities. So we can now have the illustration. So the illustration is for December 2022, question 3A. Question 3A. And for partnership, nothing will change. Debit and credit will remain the same. It's only that we will get the changes once we get the appropriation account. So if you look at that question, it says, Get Mercy and Nixon has been trading as a partners under the name Command Partnership. The partners sharing profit and loss in the ratio of 4:3:2, respectively. On 1st November 2021, an employee, Oliver, was admitted as a partner. He was to bring 7.5 million as a capital and 1.608 as his shares of goodwill. The partner do not intend to operate or to open a goodwill account. What does that tell you? As a good student of financial accounting, if examiner tells you that, it means the partners will write off whatever the Oliver is bringing, and they will share according to the old ratio and the new ratio. And the new ratio. Then we have been told the admission of Oliver has not been fully recorded in the books of account other than the cash record. So they have already accounted in the cash account. So they have given us the trial balance there with the capital account, current account, drawings, land, expenditure, all that. But I recommend to my students to start with the additional information so that you don't forget. Trial balance, they don't have any challenge because the values are there. So where there is a challenge is additional information. We have to look at number one. The new profit or loss sharing ratio was agreed at 4.4 to 3 to 2 to 1 for a new profit sharing ratio. And then on 1st October 2022, inventory was valued at 5780. That is the closing inventory. And the closing inventory we normally take to the what? The cost of sales. That's why we have credited here the closing inventory of 5780. Inventory of 5780. And then number 2. As at 31st December 2022, accrued salaries and wages and accrued expenses amounting to 7.9 million and 1.68 million respectively. How do we treat accruals? How do we treat accruals, my good learners? So for the current financial year, remember accruals are expenditure for the current year, but it's only that they have not been paid. It will be paid in the other financial year, but we have to account in the current year. That is the rule of accounting. For expenditure and income, we only account under the period or accounting period. That is 1 year. That is 1 year. So what would happen to that? We will add back to whatever they are paid in that period. So if you look at the trial balance there for salaries and wages, they have paid what? 5,000. So that 5,000 we will add back 1790. I've cut 3 zeros. So we will take the 5,000 plus the accrued one, which will come to the total of what? 6790. The same gives treatment for advertising expense. How much have they paid in the trial balance? They have paid 3580. So we will take 3580 plus whatever is accrued. No, this one is not now accrued. The accrual, yes. So this one should be plus. I've seen negative here. So this one plus this one, which will come to the 5260. That's okay. And then insurance. So insurance, where is the note for insurance? Where is the note for insurance? Note number 4. As of that 1st October 2022, the prepaid insurance amount to 660. So this one we have to subtract because it is not related to the current financial year. So we have to subtract. So whatever they are paid there as an insurance expense, which is 2,400, we will subtract 660 so that we remain at 1740. Then we go back to the what? Additional information number 6. The partners referred that they will receive a 10% per annum. That one is for capital. It will not affect the income statement. And then to go to note 7, depreciation is to be provided per annum on the cost as follows. We have the furniture, which is 12% on cost. So when they say on cost, you will take the rate times what? The cost of the asset. So the cost of furniture and fitting there, if you look at it, the trial balance is 11, not 11. So you say you have to use the ruler. 71, 100 times 12%, which will give you 852. And then we have 25% of the what? Of the motor vehicle, which will give you 2,500. After that, you take the expenditure, now go back, because we have exhausted our additional information. Then we go back to the what? The trial balance. We pick now the direct expense, which they don't have the adjustment. We started the motor vehicle expense, which is 3980. You come to the insurance, we have already adjusted that one. Office expenses, that is 3430. And then bad debt, 1730. Remember, bad debt also is an expense, which you will total them to give you 26,282. That is the total expenditure. So take the gross profit of 3333 minus the total expenditure. This says already you have them in a trial balance. This says you also have the opening inventory and the purchases. So that what will be able to give you the gross profit. So from that gross profit, you subtract the total expenditure to get the net income. So this net income is the one which you will open appropriation account so that we can distribute it to partners. So take a minute and just open appropriation account. So appropriation account is very direct. We take that net profit or the net income of 4080, and then we less the interest on capital. Remember, if you look at the two that they said, the partners agreed to charge 10%, 10% rate. So 10% rate of the capital of the each and every partner. Go to the trial balance at the top. We have been provided the capitals there for each and every partner except for Oliver. Oliver is there in the what? The first information, because Oliver is to bring in a capital of 1.75 million as a capital and 1.68 as goodwill. So for capital, you will take here for capital, and then you bring here. Remember, so that one, after if you total the total of the interest for each and every partners, you will get 24.75, which you subtract from the what? The total net income. And then we have the salary to partner. We have the salary to partner. The salary to partner is only paid to what? To Oliver. We have been told Oliver was admitted on 1st November 2021 and was paid a salary of 853,000 per annum. So you have to be keen on the date of admission. Is it a full year admission or some months? So you have to see. We are closing at 31st October 2022, which means our financial year was starting on 1st November 2021. So Oliver was a full year because he was admitted here on 1st October. So which means it is for 12 months. It is for the 12 months. It is the 12th month. So we will capture the full amount here as a salary, which if you less that one, you will get now profit to be shared of 720,000. Remember, we have other 3 zeros which we have left out. And then we share this one now according to the new ratio, which is 4 to 3 to 2 to 1, which if you total all of them, it will add up to 9. And then we multiply by this profit, which each and every partner will take his shares as this one, and then which will total to the what? The total amount. So if you subtract, you will realize you remain with nil. It's nil. So this value is the one which you will take to the current account. The current account. This value is the one which you will take to the current account. The current account on the credit side. So let's open the current account. So partners current account, there is a balance brought forward. If you look at natural balance at the top, we have been given the list of balance brought forward for the partners, which if you forget, we are 4350. It is in the, you have to be keen when taking the balance brought forward, because it is a mixture of debit and credit. So this is on credit side, and also for Nixon, that is 780, that is on credit side. The one which was on debit side, you will take to the debit side, which is for Mercy. Remember the Oliver was, we introduced the Oliver in business, so there is no balance brought forward in this case. And then we have, let me charge camera, laptop. Yes, that's fine. And then we have the interest on capital, which this one we are driving it from, or we are getting it from the appropriation account. You just copy paste 950 for Get, for Mercy, 750, 600 for Nixon, and 175 for Oliver. we have the salaries. Salaries here, it's only one partner who is getting salaried here. Oliver is a salaried one. So we bring our salary here of 853. And also the profit here, we are getting this one from the appropriation account, which get us 288, Massey 216, Nixon 144, and 72 for Oliver. And then on the debit side, we also have the drawings. Forget that 500 as per the accounts, or as per the trial balance, that 500, 3,000, that 200, and 2,500. And then, so you'll find that the balancing figure will be on a credit and the other one also will be on a debit, like the one they have also provided us. So forget, you will find a balancing figure is on a credit of 2080, the difference between a total of this minus the total of this. So the difference is 2880, which is on a debit. That is the balancing figure. Massey, debit is more compared to the credit. So the balancing figure will be on a credit side of what? 43, 14. And as that event for Oliver, it is on a credit side of 1400. So this one, so this value, and this value, and this value is the one which you will take to the what? Is the one which you will take to the partner's current account under the equity and liabilities, under the equity and liabilities. So let's open the partner's fixed capital account. Then from there, we open the balance sheet and then we end our class. So I've been writing without explaining. So let's now explain. So we have this is the goodwill. Remember the goodwill, we have been told that the partners, they are not to maintain the goodwill. They are not there to maintain the goodwill account. So we should write off. So we will write off with a new ratio, which we will debit the value of that goodwill. So the new ratio is 4 to 3 to 2 to 1, which we will distribute that 680 as per that, and also we will distribute on the credit. So the one which is in on a credit here, as I've said, we will bring to the what? To the debit. This one is the one you will bring here. So we have the goodwill here, and also we have the goodwill here. They have the goodwill here. So that one, if you add this and add this and add that one, you'll be able to get the closing balance. You will be able to get your closing balances. You will be able to get your closing balances. And then from there now, you can be able to open now the balance sheet. So let's have a look at the balance sheet. So for balance sheet, we start with the non-current assets. As per the trial balance, we have land and building, which they have not been affected by any transaction. So we bring that value of 11,500 as per that trial balance. And then to come to the furniture, remember balance sheet, we account the asset as per the net or the net book value. We don't account using the cost. So we'll take the cost of the furniture, which is 71,100 minus the accumulated depreciation. It is there in the trial balance, 41,100 minus the current or the current depreciation, which we calculated there, 12% of the value of the furniture, which will give us the total. So if you add these two, you get the accumulated depreciation. Subtract that one from the cost, which will arrive at the net book value of 21,40.48. The same goes with the motor vehicles. We take the cost of 10,000 minus the accumulated depreciation, that 550 minus the depreciation charge for the year of 2,500, which will arrive at the net book value of 31,30. So if you add this one, you will be able to get the total of non-current asset as 16,798. You come to the current asset. Here there are no adjustment. It is just copy pasting. This one as per the trial balance, that 550. Repayment insurance as per the note 3, the prepaid insurance, which is 660. You just copy this one. The closing inventory as per the note 2, which is 5780. And then we have the cash as per the trial balance. There is no adjustment, 1650. Bank also here 2110. There is no adjustment. You get this one as the total current asset, which if you add this plus that one, will be able to get the total assets. You will be able to get the total asset of 36,6488 as per the calculator. This plus this, that is the current asset plus non-current asset. And then for the equity, this one we are just driving it from the what? The fixed capital account, the closing, the balance carried forward, which if you put for each and every partner, you'll be able to get the total of 26,430. The same goes with the current account. This one is coming from the partner's current account. You extract from each partner, that is the balance carried forward. You will realize this one is a negative because it is on the credit side. It is on the credit side of the partner's current account. The same goes with this one. It is on the credit side. That was a negative, which if you accumulate all of them, you'll be able to get a negative. You'll be able to get a negative of 23,202. So then, because of the space, we have to prepare now the current liabilities and non-current liabilities, so that we check whether it is equating to the total assets, whether it is equating to the total assets. So let me wrap there if you have taken the notes. So for current liabilities, we have account payable, accruals, which is salaries and advertising as per the additional information. So we have 1790, 1680. We have the total will come to 6280. That is for current liabilities. Now, so if you take this current liability of 6220 plus this, will be able to get a total of 3648, which will be the same with your total asset. It should be the same in total asset. So the more importantly, when doing exam, it is not to balance like the way I'm balancing it, because me, I'm teaching it, so I know. But for you as a student who is preparing to do exam, the key thing here is format. For student, we do mark the entries. We don't mark the balancing figures. So we only mark the correct entries. So there are a lot of free marks here by just putting the correct figures at the correct entry. So make sure that you master the format. You get a lot of free marks here. So thank you, and let's meet on the next lesson, which is topic 7.